imported, utilized in manufacturing ceiling. Manufacture is done in your factory. You are exporting the ceiling fan. When you are exporting the ceiling fan, the ball bearing which you have imported are automatically exported by default. They are not consumed in India. As I said, taxes are payable for consumption. Product is consumed in India but not utilized in India. Therefore, taxes have to be exempted. Now, how to understand this critically? So, first part, inputs are subject to import duty plus IGST if they are imported. Local procurement is subject to payment of GST. Finished products are sold subject to GST when consumed in domestic market. Exports are treated as zero rated under GST regime, and therefore the refund of GST would be available. If you understand these two concepts, you automatically understand how it functions. In order to get neutralization of duty for inputs, exporter has to interact with following four departments: GST Commissioner, with the help of tax invoice and shipping bill. Shipping bill says which product you are exporting. Tax invoice says what is the applicable amount of GST. Customs, with the help of documents like shipping bill or bill of export and bill of entry. Bill of entry explains what are you importing. Shipping bill explains what are you exporting. DGFT, credit scripts and authorizations, which are utilized or issued, which were earlier issued as incentives for the purpose of MEIS or SEIS. Currently, this is gone. Now, it is for authorizations. And authorized dealer or bank, EBRC, is a document which explains you that what you have exported, money has been received. Bank is confirming you exported the goods worth $10,000. $10,000 are received in the bank. Bank issues a certificate called EBRC, and based on the EBRC, you would be able to monitor your authorizations. That is how conceptually it goes. Now, when it comes to inputs, when you want to manufacture a product, you require these. You require raw materials, you require components, you require consumables, you require accessories, you require parts, you require spares, fuel, catalyst, packing material. What is meant by input? Input means all those ingredients which are required for manufacturing or packing of a product. Now think of this. My order is $10,000. My import value is $6,000 and my duty average is 30%. The biggest question in front of my mind is, I'm importing material worth $6,000. 30% duty is $1,800 multiplied by currency, so many rupees. If I pay those rupees to the government, product is not consumed in India. The final product is exported out of India. That means the components I have imported, the raw materials I have imported, got converted into a final product. Final product is exported out of India. That customer is not going to pay Indian taxes. Government should allow me clearance of these goods without payment of taxes. Or if I pay taxes, they should allow me refund. Simple principle. But understand the implication. Now I will take higher values so you understand. Your exports are 1 crore, your imports are 60 lakhs. On 60 lakh, 30% duty you are paying. That means you are paying 18 lakhs of rupees. Normal circumstances, you will go to the bank, take 18 lakhs of rupees, borrow it from them. You will have to refund that money and you will also have to pay interest cost. So government says, you take advance authorization, don't pay this duty. Give me undertaking. What is that undertaking? You will export the manufactured goods. So on one hand, I'm saving the interest cost. On other hand, my cash flow doesn't get impacted because I'm not paying the duty. And government also has a control that, okay, I will monitor. I will give you time to export the goods. As long as you export the goods, I have no problem. Because goods are manufactured in India, but ultimately the products are consumed in export goods. Export goods are sent outside India. There is no consumption in India. Very interesting concept. Then I come to machinery. What is machinery? Machinery means any plant, equipment, accessories required for production directly or indirectly. All the machineries that are being imported into India, all the equipments that are being imported, all the accessories that are being imported, they are not likely to be exported. They are in India. I import a machinery, I install that machinery. Machinery is ever going to stay in India. So government says, okay, you pay duty because these products are not exported. But I will give you a concession. You take a EPCG authorization, import the goods, I will not collect duty from you, provided you take a definite export obligation. I will fix what is the rate, etc. You take the definite export obligation. When you complete that export, then I will not collect duty from you. If you default, I will collect duty from you. So new scheme comes into picture called EPCG, Export Promotion Capital Goods Scheme, which allows you to import capital goods, which also allows you to import spares, because spares are required for maintenance of capital goods, and therefore it is critically important that I must look into this aspect as well. And therefore, when I look at these two aspects, I will find that the schemes have to be considered, because I do not want to pay indirect tax for exports, not at the level of export, not at the level of imports. At both places, I do not want to pay indirect taxation. Critically important. Understand, your business is 100 crores exports. Your imports are 60 crores. You are straight away saving 18 crore rupees payment of duty by utilizing the scheme called duty exemption. It's very interesting to see that the most prominent scheme are those schemes which exempts the importer from payment of duties. So he is free from indirect taxation. As I said, taxes are collected for the purpose of public welfare, and you will find it very interesting. Some of you might have read the custom notification. If you read the custom notification very carefully, the first para says it is issued in public interest. Why is the word public interest? What is public interest? Since the taxes are collected for public welfare, exemption has also to be granted in public interest. It cannot be given to you personally. Now, what is the public interest? Public interest is defense. Public interest is R&D. Public interest is healthcare. Public interest is export, because export earns foreign exchange, which is critically important for meeting my requirements of imports. So whatever is covered under the public interest, government will issue a notification. And only when a notification issued by customs, you can get exemption from payment of duty, not otherwise. Therefore, every single scheme of the policy granting any kind of exemption is governed by customs, and customs will issue a notification telling you which duties are exempted. Every scheme of the policy will be supported by a customs notification. So chapter 4 basically talks of duty exemption and remission schemes. related to inputs. This is critical, related to inputs. What is inputs? We have already seen. This is the list of inputs. I'm exporting a product. I want imported inputs for that. All of them can be covered without payment of custom duty by obtaining an advance authorization under duty exemption scheme covered by chapter 4 of the policy. Now suppose my quantity is small and I'm not in a position to claim authorization. I'm a small exporter. So government says, okay, you're a small exporter. I will allow you to claim refund. You have imported something, you paid duty, you have exported the product by utilizing the material which you have imported. Whatever duty you have paid, proportionately, I will refund it to you. So you get back the refund. That refund is known as remission scheme. So let's understand. Duty exemption scheme, commonly known as advance authorization, gives you exemption from payment of duties based on input-output norms. Yesterday we were discussing input-output, that for manufacturing of one shirt I require 2 meters of fabric, 2 meter, one shirt is my output, 2 meters is my input. Ratio is fixed because based on the ratio, what import quantity is fixed. Based on the import quantity, duties are calculated. So based on input-output norms and incidence of duties, what is the advantage for the exporter? No blockage of funds and no payment of duties involved, no interest cost, because you're not borrowing money from the bank because you're not supposed to pay duty. What happens in duty remission scheme? You first pay the duty and take it back from the government. This is done in two ways. One is known as all industry rate of drawback, and second is known as brand rate. This scheme itself is known as duty drawback. Please understand, the word itself suggests drawing back. So when you have paid the duty, then you will take it back. Whatever duty you have paid, if the same duty you are taking back, how can it be said that it is an incentive? It is not an incentive. It's a tool of indirect tax management. Now, what are the problems here? Funds are blocked because you have paid the duty. And if it is taking time to take back the drawback, then interest cost also to be borne by you. These are two primary tools related to inputs. When we talk of advance authorization, when we talk of duty drawback, they basically talk of duties covered under customs. There are duties and taxes which are not covered under customs. For that, there is a new scheme called RODTP. These are indirect taxes embedded, collected by central government and state government or other tax levies, but not subsumed in GST, or wherever they are subsumed, not refunded otherwise. You need to refund these monies also to the people and to the exporters, and therefore there has to be a calculation. I have done extensive research work on this subject. I was working for 4 different export promotion councils, and we studied this in depth. So I can give you exact idea of RODTP. RODTP is not a scheme of incentive. First point to understand. It is a scheme of refund of taxes. Since it is not an incentive, you cannot compare this with earlier incentive schemes. Earlier incentive schemes like MEIS, where the incentive rates were between 2% to 5%. You cannot compare this scheme. RODTP is a completely different scheme. There was this misunderstanding for quite some time because government has said while making announcement that okay, post MEIS we will introduce a new scheme called RODTP. A lot of people felt that this is the scheme substituting this scheme of MEIS. It is not substitution of MEIS. This is a scheme of refund of taxes, completely different. But taxes which are different in nature. So let's understand. There are certain taxes which are not subsumed in GST. Such taxes add to the cost of production and transportation, including inward and outward movements. For example, movement of raw materials, components from port to factory, and movement of finished goods from factory to port. Understand this carefully. You are exporting goods. You are bringing an empty container to your factory, fill the cargo into that container. Container goes out of the factory, goes to the port. Does it go free of cost? Answer is no. Container has to be loaded on a vehicle, let's say on a truck. Truck carries it. Truck runs either on gas or on diesel. The fellow has to pay, the truck driver or the transporting company pays this. Let's say the transport company tells you for taking your container to the port, we will charge you 20,000 rupees for a 20-feet container. This 20,000 rupees is cost of transportation, not cost of diesel, and also not cost of taxes. So let's take a case that okay, 20-feet container taken from your factory to the port cost 20,000 rupees as total transportation cost, and 8,000 rupees are required for payment of diesel. And out of those 8,000 rupees, 4,000 rupees is the cost of central excise duties and VAT. So what is refundable to you is 4,000 rupees, not 20,000 rupees. So transportation taxes. Now, depending on product to product, the cost increases. Very simple to understand. Let's go by a family example. I give you a 5-liter can. And I ask you, go to the market, purchase 1 liter of kerosene, 1 liter of groundnut oil, 2 liters of milk, and bring it. Can you use the same container? Answer is no. Why? Products interact with each other. If I put in the same can kerosene, milk, and groundnut oil, I can guarantee you none of the product can be used. So if you are exporting chemicals and you are importing chemicals, your transportation cost is high. These costs have to be taken into account because if I put them, the word utilize is embedded taxes. If I add to the cost of production, my product will become costlier. My importer will not buy that product from me. So these taxes have to be refunded. Again, based on the principle. So this is logically correct. This is also compliant with WTO rules. Now, which are the taxes considered normally under this scheme? The taxes which are considered are central excise duty and state VAT on petroleum products, electricity duty. When you manufacture goods, you use electricity. If that electricity used by you have taxation involved, coal cess is there, diesel petrol taxes are there for generation of electricity. If your product is a farm product, then mandi tax is there. Then there are certain taxes which are not refunded in the GST scheme. For example, insurance, tires, tubes, spares, motor vehicle taxes, toll taxes. If goods are coming from Pune to Mumbai and passes through highway, expressway, then it is supposed to pay toll. Stamp duty on export-import related documents. These taxes have to be calculated. Their percentage has to be fixed based on the FOB value, and that amount has to be given back to you because you have exported the goods. So what are the elements? Electricity duty differs from place to place because electricity is different in different states. Depending on where your factory is, you'll have to think about this. Taxes in transportation, very, very critical aspect because transport operations are optimization of transport operations, maximizing movement of goods at minimum possible costs, availability of raw material, production schedules, post-production treatment. Lesser the optimization, more the transportation cost. These are all critical aspects of trade. And then what all it involves? This cost keep on going, increasing, decreasing based on number of situations, bad road conditions, heavy traffic, distance between manufacturing or warehouse location and port of export, long waited tool booths, long waited ports, vehicle capacity, availability, fill rates, loading and unloading time, number of trips. Many times the transporter says, return bade ka kya hoga? I'm not getting any return fare, so you pay me money. Some people take toll taxes twice because goods have to come back. The vehicle has to come back. When it comes back, it has to pay the tax, toll tax. All these have to be thought of while calculating. Then you need to maintain profit margins. I can give you some international examples. A company who was exporting goods to Argentina and earning decent amount of profit during the COVID time discontinued exporting to Argentina. When I started examining the case and I asked them questions, why you have discontinued? They said the freight that we used to pay for a 20-foot container up to Argentina was $3,000. Post-pandemic, the freight payable for the same distance is $11,000. So the freight has increased from $3,000 to $11,000, and I don't make that much profit that I can afford to bear the cost of the freight. So it is better for me not to export the goods. Ultimately, cost matters. Nobody wants to do business for losses. Everybody wants to make money. Everybody wants to earn profits. And legitimately correct, they should. That is how business will flourish. So taxes in transportation play a very important role. Going forward, understand this because this is critical information. Let me tell you. 95% of our transportation, industrial transportation, is dependent on fuel. And that fuel is from petroleum products. In other words, it is from the product that is generated, which is used in transportation, is from petroleum base. That means it is from crude oil. Because the crude oil prices were down, understand this. This is very important for future. And the Russia-Ukraine war, energy costs have increased, skyrocketed in European market. Last week, OPEC Plus, that is inclusive of Russia, decided to cut the production of crude oil. And you know what is the situation? In 1 week, the prices internationally of crude oil has increased by almost 6%. The price, which was ranging about $76 to $80 per barrel, is expected to touch by May somewhere around $90 to a barrel. Understand the impact. 1 barrel is 159 liters of crude. It is going to increase our import bill. It is going to increase the cost of diesel and petrol. It is also ultimately going to include the cost of gas. If all this put together, your actual cost of transportation, suppose it increases by 10%, it is going to impact every single industry, because every single industry requires transportation, cannot be avoided. If you understand these complexities, we automatically understand the importance of getting the taxation back, because that is how we make our product competitive. Stamp duty on documentation. When you import goods, 0.1% is charged by Gujarat and Maharashtra ports. This is again tax collected by the government. Mumbai, Pune recently, from 1st April, again, the toll tax has increased from 270 to 320 rupees. These are all addition to the cost. And this has to be absorbed because I want to continue with my business. My buyer must be prepared to pay me that amount of money. Otherwise, I will not get money. I will not make any profits. Probably I may not get the orders. So refund of taxes is a very critical aspect in any export activity in any part of the world. So the scheme was announced. When the scheme was announced, it implemented with effect from 1st August 2021. At that time, ready-made garments, steel, chemicals, pharma products were kept outside the purview of this scheme. The notification was issued. Notification number 19, 17th August 2021. No separate code was required. HS code is sufficient for claiming the benefits. And they have categorized some ineligible categories that if you're operating as an EOU, if you're advance authorization holder, you will not get this. This still continues, but there is a change. Current updated notification for new RODTP rates is notification number 55, 25 to 2023. So if you want to check what is the RODTP rate, you can refer this notification. And if you visit the Indian Trade Portal, you can check it online. What is the amount of RODTP rate applicable to your products? Another scheme, ROSCTL, July 14th was introduced. This is rebate of state and central taxes and levies, but for garment exporters. So this scheme is applicable only for garment exporters, because there are different kind of calculations that were calculated under this, and the scheme operates. So there are two schemes. For garment sector, you have ROSCTL, and for other products, you have RODTP. Again, both the schemes aim at refunding taxes to you, which are inbuilt into the cost. Now let us come back to advance authorization. Advance authorization has three different versions. Advance authorization, duty-free import authorization, annual advance authorization. What is the difference between the three? Advance authorization can be against an order. You can claim it against an order. If you are an established exporter, you can claim it as annual. When you claim it as annual, you are saying this is my estimated plan. I am likely to export goods worth 5 crore rupees. Against this export of 5 crores, I require materials worth 3 crore rupees imported. So give me a license for import of 3 crore rupees without payment of duty. That is annual advance authorization. Or you say I have an export order for 5 lakhs of rupees. I need a license only for 3 lakhs of rupees. So I'm making a simple application for 3 lakhs. That is common advance authorization. There is something called duty-free import authorization, where I will make the application, but I will not import the goods. I will first export. by purchasing local material. This is mostly useful for merchant exporters. And then I'll claim the authorization. Post-export authorization will be issued to me. I am allowed to import the goods covered by the authorization. And if I do not want to use it, I am allowed to sell it. So as a merchant, I sell it to someone else who is an importer. He will import the goods and I will get some premium against that. So these three instruments are utilized under the duty exemption scheme. There is one special scheme for gem and jewelry. There are 5 different versions: advance procurement or replenishment of precious metals from nominated agencies, replenishment authorization for gems, replenishment authorization for consumables, advance authorization for precious metals. Understand, gem and jewelry is a little different sector where the quantity and weight is small, but value is very high. 1 container load of cotton and 1 container load of gold. Do you understand the difference between the two? 1 container load of cotton, very easily taken care of. 1 container load of gold, 20 metric tons of gold. It is such a high value. You can imagine 60,000 rupees per 10 grams. So 6 lakhs rupees for 100 grams. And 6 lakhs into 10, 60 lakh rupees for 1 kilo. Can you imagine what would be the value of 20 metric ton? You will not be able to sleep. So the product which is of very high value, the product which generates employment, but the quantity is small and the value addition is also small. It's very interesting to see. Nobody gives you discount on gold. During Diwali days, you see the small print, it always says discount on making charges. Nobody gives you discount on gold. Can you do it like this, that you go to a shop and you say you are buying, the scheme is there. You buy 4 shirts, 5th shirt is free. Can you go to a jeweler shop and say, I will buy 4 necklaces, 5th necklace is free? Sorry. Product is too costly, too precious, and too important. Your currency is the value to the currency depending on your gold reserves. Your capacity to borrow from institutes like IMF depends on gold reserves of the country. Precious metal, you need a different kind of policy for them because here quantity is small, value is high. All these instruments permit import of inputs without payment of duty for the purpose of export production. Please understand this clearly. All tax exemptions are granted for export production. It is not granted for local production. You are supposed to pay duty for local consumption if the goods are manufactured in India, sold in India, subject to taxation. Now, what are the basic coverages in the old scheme? First, let us look at that, then we'll look at what are the changes in the new scheme. Provisions for advance authorization import coverage, all inputs required for manufacture or packing of a product. I already told you. Export obligation is governed by quantity and value. What is meant by quantity and value? I cannot import more material than what is consumed for the exact quantity exported. And I must earn some additional amount of money, which is commonly known as value addition. The value addition for advance authorization scheme is 15%. In other words, if I'm importing goods worth $100 and manufacture a product, I must at least earn $115. $15 is addition to my kitty, my government kit. Because I'm spending $100, I'm earning $115. So it is governed by quantity and value. Once you get an authorization, import period is 12 months, export period is 18 months. If you cannot complete export in 18 months, there are provisions for extension, and you were supposed to pay fee for extension. Yesterday we have seen these are drastically reduced for MSME sector. And penalty for non-compliance if you do not. You have taken authorization, you have imported the goods, but you did not complete the exports. Normally, government will recover duty, what you have saved, plus interest at 15% per annum rate. Normally, they will not charge you any penalty. Penalty will be charged only if you violate the conditions, not otherwise. Now, why this is critically important? Because sometimes, because of external situation, order gets cancelled, and in spite of importing, you will not be able to complete the exports. If that is the case, yes, I should give you this particular relaxation that you pay me duty, you pay me penal interest at 15% per annum, I'll close your case, no problem. This is when I am claiming exemption from duty. I am not paying duty at all. Now let us come to a second case where I pay duty and I want to take it back. Remission scheme, commonly known as duty drawback. Here the government says, you pay duty. When you import the goods, you are paying duty. You are paying basic custom duty. You are also paying IGST. When you pay IGST, you are a manufacturer. I am giving you a credit. So there is no refund. But custom duty is your embedded cost. Custom duty must be refunded to you. In good old days, input service and service tax was taken into account. Now both are not in existence, so they are withdrawn from the whole system. Drawback is limited to incidence of duties of customs on inputs and central excise duty. Suppose you are a manufacturer of lubricants. You have imported oil, utilize it for making the lubricant. On oil you have paid, but that duty is not paid as customs duty, it is paid as central excise duty. You must get back that particular duty. So the drawback rates were announced. The notification 7/28/2020. What is the system of drawback? So there are three systems of drawback. The first one is known as all industry rate. All industry rate is a rate fixed by the government. You have not to prove anything. It is based on average incidence of duties on inputs. Shipping bill itself is an application. So you have to file the shipping bill, tick mark the column, say this is my rate applicable for my product. Government will credit that money to your account. You have to open a specified bank account for this particular purpose. This is automated process. Now take one example. You are buying copper wire for Birla Copper. And you have exported copper wire. You have not imported anything. You bought the copper wire from Birla Copper and you exported. But please remember, India is not self-sufficient in copper. So Birla Copper must have imported some copper. That copper is utilized in manufacture. Average incidence is worked out and money is paid to you. So if your product has all industry rate, you can claim it without doing anything else, tick marking on the shipping bill. Now suppose the list published by the government doesn't have your product. Then you have an option to claim brand rate. What is the brand rate? Rate will be fixed only for you. Now understand this. Suppose you are exporting a product at 100 rupees. No rate is fixed for your product. Your import is 20 rupees. And basic custom duty on your product, your imported product is 7.5%. So on 20 rupees imports, you have paid 1 rupee 50 paisa. Your export value is 100 rupees. 1 rupee 50 paisa compared to 100 rupees is 1.5%. So government will grant you 1.5% drawback rate only for you. That is known as brand rate. How will they grant? They will ask you the proof of duty payment. They will ask you the bill of entry. They will ask you when you have exported the goods, the shipping bill. They'll ask you your stock statement. And based on all this, after due checking, they will give you a letter. Based on this letter, custom will release that money to you. This is a second case. This is covered under Rule 6 of drawback rules. This is a third case called special brand rate. What is that case? Special brand rate is a case where you have all industry rate for your product, but your actual imports is much higher. The rate fixed for your product is, let's say, 1.5%. But your actual calculation of basic custom duty comes to 3%. So government says, you apply for 3%. Give me documentary proof. And I will fix the rate for you at a higher percentage called special brand rate because your product is covered under all industry rate. So practically there is no difference between brand rate and special brand rate. Mechanism is same. Only difference is in case of brand rate, all industry rate does not exist. In case of special brand rate, all industry rate exists, but it is inadequate. This is how the remission scheme is monitored. Again and again I say, advance authorization and duty drawback are not incentive schemes. People come ask me this question. And out of ignorance, they also go and say, nahi, government ko na drawback rate badha ke dena chahiye. It's not an incentive. Drawing back, money paid is refunded to you. So what you have not paid cannot be refunded. Second part to remember, advance authorization and drawback are mutually exclusive. Because if you have claimed exemption, you cannot claim refund. When you have claimed exemption, you have not paid the money. If you have not paid the money, there cannot be a refund. And I can put it in a very joking manner. Refund my 1,000 rupees, which I never gave you. Then you are saying, what are you talking? Absolutely nonsense. If you have not paid me money, there is no question of giving you refund. So when you understand the scheme of drawback, please understand, drawback can be claimed as all industry rate or brand rate or special brand rate. But you cannot claim advance authorization and drawback simultaneously for the same product. Either you claim advance authorization, don't pay duty, or you claim drawback, pay duty and take back. So all your input duties are taken care by two schemes, advance authorization or drawback and RODTP. It is expected to give you refund of all taxes that are involved in calculation of taxation, indirect taxation in the cost of exports. Critically important to understand this. Because if we understand this, then we will understand that this is not a scheme of incentive and this scheme is WTO compliant. What WTO says? We export goods and services, we do not export taxes. If you are not granting me any incentive, I am compliant with WTO. WTO has a very clear-cut understanding on this subject. If you give subsidy, if you give incentive for your indigenous purposes, we are not worried. If you give subsidy on export goods, then we are worried because that subsidy can be converted into an incentive. And that incentive can actually lower the cost of your product. And this is an unfair trade practice. You are artificially reducing the price of the product because your government is granting you incentive for this. So this is something every exporter must critically understand, workable or not workable. You have to see that and understand how it practically functions. The second scheme is EPCG scheme. I had a doubt whether the scheme will continue in the policy or not. The scheme continued. Good. It allows you import of capital goods and spares subject to export obligation. Please understand, in case of advance authorization, whatever you import by default goes out of the country. In capital goods never go out of the country, they stay in the country. You import machinery, install that machinery. You have not paid duty. Government has granted you concession. That concession is granted to you in public interest, because idea here is you will upgrade the facility, your product quality will improve. If your product quality improves, the chances of exporting also improve. So upgradation of technology, critical aspect. In upgradation of technology, the scheme that is utilized is called duty exemption scheme for capital goods. It is nothing, EPCG, export promotion capital goods scheme. How the scheme operates? Import coverage, capital goods and spares, second-hand goods not allowed. Only new goods have to be imported. Time period for import, 24 months. Export obligation, only value. 6 times the duty saved amount. 6 times. Understand, I'll give you an example. You are importing machinery worth 1 crore. Your duty saving amount is 30 lakhs. 6 times of 30 lakhs you will have to export. What you will export? Goods manufactured by use of that machinery. So 1.8 crores, 30 lakhs you have saved, 1.8 crores is your export obligation. You are supposed to complete it in 6 years. Now understand this little differently. You install the machinery worth 1 crore. Your actual production out of that machinery every year is 5 crores. In 6 years, you have manufactured the goods equivalent to 30 crores. Out of the 30 crores production, if you have exported 1.8 crores, the duty exemption granted to you stays with you. If you fail to complete this obligation, I will recover the duty and interest proportionately. You are supposed to complete export obligation of 1.8 crores. You have completed only 90 lakhs, 50%. Balance 50% duty. So you have saved duty of 30 lakhs. 50% you have completed obligation. I will remove 50% duty out of that. So it remains 15 lakhs. 15 lakhs plus interest from day one. I will collect it from you. That is how the scheme operates. And if I cannot complete export, there is a possibility, there is a methodology of giving 2 years extension. So instead of 6 years, complete the export in 8 years. This is how the scheme operates. Then comes a very, very critical aspect, chapter 6, which is export-oriented units. Extremely important concept. Let me give you some idea of this, because this is very much for new people, young people. What is an EOU? EOUs are dedicated establishment for exports. All indirect tax benefits given either by way of exemption or refund. You are also allowed 100% FDI permitted through automatic route. The scheme started in 1981. Now understand this, you are an entrepreneur, but you don't have money. You have a strong desire. And you found out a person, let's say in UK or in Germany or in France, and you have given him a business plan. You will supply me goods, you will supply me machinery, you will supply me technology. You will also give me money. Then the question comes, why should I do this? So you tell him, in India, labor is cheap, environmental is friendly. I'll manufacture the goods based on all what you have given to me. Some portion I will export it to you, you distribute. Some portion I will sell it in India. All cost will be borne by you. You are giving me technology, you are giving me machinery, you are giving me anything else that is required, including money. This scheme has become extremely successful in India, and people have set up UOUs. In good old days, 66% of production had to be exported, 33% was allowed to be sold in domestic market. In the policy of 1520, this condition is removed. Now the policy says, you sell any amount abroad, you sell any amount in India, as long as you are a net positive foreign exchange earner. So if your imports put together, your foreign exchange outflow put together is 50 crores, and your export value, irrespective of the level of production, is 51 crores, good enough, no problem. This scheme has 4 versions. Export-oriented unit for normal products. ESTP, electronic hardware technology park. So electronic machinery manufacturing or assembling you are taking place. Then STP, software technology park. You are putting up a unit by importing machineries, but output is software. And biotechnology park. So these 4 versions are covered under this scheme. Extremely good scheme for any person who wants to be an entrepreneur, because this allows 100% FDI, foreign direct investment, through automatic route. How do you work on the scheme? The benefits: indirect tax exemption. Whatever you import, indirect tax is exempted. Whatever you purchase locally, you can claim refund of GST that you have paid. If you are working for a third party, you can claim drawback. Whatever you purchase, you are entitled to take input tax credit of the GST that you have paid. So you have option, refund or input tax credit. 100% of your export earnings can be retained in EFC account. EFC account stands for Exchange Earners Foreign Currency Account. You need not convert the money, because any export-oriented unit has imports coming into the country. You can utilize the dollars for imports without, you are free of exchange fluctuations. And money you can receive under automatic route. What are the operations of a UOU? There are 10 operations, basic 10 operations. You are importing, you are procuring locally, you are manufacturing the product and exporting. You are also selling in domestic tariff area, DTA sales. And if you have more orders than your build capacity, you can also get subcontracting done. No problem. What are 5 other activities, major activities covered under UOU scheme? You are allowed inter-unit transfer. If you are a big company, you have 2 units, same ownership. One is situated in Chennai, another is situated in Bangalore. You can make inter-unit transfer of goods. You are allowed to export through third parties. It need not necessarily be your own. You can sell it to someone else, he will export the goods. If you have imported goods and they are unutilized, you are allowed to sell them in local market subject to payment of duty. You are allowed to re-export them, no problem. If you have excess GST lying with you, you can claim refund on quarterly basis. And the notification governing UOU also gives you provision for re-import and re-export of goods. When is re-import happening? If you are exported a product, let's say engineering product, it is found defective, you want to bring it back, no problem. Notification permits. Or re-export, you imported machinery, you found it defective, you want to send it back. That is also allowed. Nowhere indirect tax comes into picture. Again, EO unit gets registration for a period of 5 years. It has not to apply for EPCG authorizations. It has not to apply for advance authorizations, nothing. So it is free of licensing. It's a very good scheme for any entrepreneur. And hopefully, the indirect tax exemption continues. So far, it is continuing in the new policy announced on 31st March. It is continuing. No problem on that particular account. This is something one has to understand carefully well, critically well. The scheme has not come to an end. The scheme continues. It is operating even today. And very good scheme for those people. Let's say you are an engineer, you want to develop your business. You are into business, you want to grow. You have friends abroad wanting to help you. Because this is one scheme which allows 100% FDI through automatic route. And then you can also integrate these schemes into schemes like production link incentive scheme, where increase in domestic sales can give you some additional incentive from the government. The scheme is commonly known as PLI, production link incentive scheme for 14 sectors. Government has introduced some more scheme for textile sector, cluster development, etc. That you can look into. So if you are seriously desirous of creating establishment for yourself, and it's a very interesting kind of a proposition, because I know where the people have said that I will appoint you as MD of the company, Indian EOU. Your salary will also be paid from countries abroad, and you will be given some shareholding benefit, some profit percentage given to you. So your dream of becoming a businessman of repute, of international scale, and without having money in your pocket, it is possible because of this scheme. So if you have that inside your heart that you want to become something like this, and you have established good relationships abroad, you think of this particular scheme. It is still a worthwhile consideration. There was a lot of talk going on about the scheme. And there was a class of people in India who said EOU scheme needs to be withdrawn, or it doesn't have any more purpose, because from 1999 to 2000, the scheme was entitled to claim income tax benefit. That benefit was withdrawn in 2010. That is why a lot of people have said scheme mein kuch rakha nahi hai. But scheme is even today workable. And if you make money, pay taxes, nothing wrong. But this is a good scheme for operational purpose, for moving into these operations. And this is something we all must seriously consider. So in understanding of the scheme, understand this critically well. 3 chapters we have seen yesterday. Chapter 4, duty exemption scheme and duty remission scheme for the purpose of inputs, materials required for manufacture of goods, commonly known as inputs. Then chapter 5, export promotion capital goods scheme. Export promotion capital goods scheme relates to machinery and spares. And chapter 6, EOU scheme, export oriented units, where the focus of the industry is on exports. All the 3 major schemes of Government of India covered under the policy, chapter 4, chapter 5 and chapter 6, are indirect tax management schemes. Understand this very carefully. Indirect tax management scheme. In other words, they 99% allows you exemption from indirect taxation. And when you get exemption from indirect taxation, your burden of indirect taxation, which is 28 to 30% in India, that completely goes off your shoulder. Of course, you are supposed to comply with conditions. That's a different story. But basically, it creates an environment where it is possible to increase exports substantially by utilizing these methods. Having understood the basics, now we'll look at the important amendments carried out in chapter 4, chapter 5 and chapter 6. But we will do that after a small 10 minutes bio break. My watch shows 4:29. So we will come back at 4:40 and we will continue. We will go through the changes covered in chapter 4, 5, and 6, and then we'll study further chapters 7, 8, and 9. So that we will continue after the 11 minutes bio break. So see you back at exactly at 4:40. Thank you.
Sir, you can share the presentation.
Okay. Okay, friends. So we'll start with the amendments carried out in the new policy in chapter 4, 5, and 6. Just one sec.
सर पीछे वाली स्लाइड पे जाना है क्या?
नहीं, 1 minute.
Okay.
Trying to reduce the size of the photo.
This is actually okay.
Yeah, but some portion of that is not seen by me. So let me.
Okay.
I won't be able to see them. Yeah. Is it okay? Hello?
Yes, okay.
Yeah. So some schemes that have come up, special advance authorization for articles of apparel and clothing accessories. Here the government has said that the authorization may also be issued on the basis of self-declaration. That means norms will not be fixed by Government of India. You can do it on your own, and they will be conveyed to DGFT. DGFT will fix the norms within a period of 90 days. There is a separate clause created for this 4.07 and self-ratification scheme where there is absolutely no need of going for fixation of norm. There they have made some amendments where alternate or additional input. Now explanation is given. If the input specified in the norms are X1 and X2 only, and input Y would represent an additional input, RA may issue, regional authority may issue advance authorization in such cases, need not be referred to norms committee for ratification of norms. Application under this scheme shall be made along with certificate from chartered engineer in the prescribed format. What does this mean? Suppose the standard norm for your product says one material available to you, HDP, high density polyethylene, and you want to claim low density polyethylene, then it says it is an alternate item not covered in the norms, but fixation of norms for this purpose will not be referred to Delhi. It will not be referred to the norms committee. It will be done on the basis of a chartered engineer certificate. You have to submit that chartered engineer certificate in a format, prescribed format, and you will be able to get this self-ratification scheme. Then it also says, because earlier the self-ratification scheme was applicable only for AUO holders. Now they have added one more clause. A status holder who is a manufacturer cum actual user and holds valid 2-star or above status, who has already submitted its application for grant of AUO on CBIC's portal, is also eligible to apply for this scheme. In other words, if you are holding the status of 2-star export house as per the new policy, and you have applied for a grant of AUO portal, AUO status on the requisite portal, and you are able to submit a copy of the application, based on that, they will allow you self-ratification norms. Ineligible categories, please remember, under self-ratification scheme, you cannot take any item where the basic custom duty is more than 30%. Earlier also this condition was there. It was talking of chapter 1 to chapter 24 of HS codes. Now very clearly they say any item where the custom duty, basic custom duty rate is more than 30%, that item has to be approved by the government. You cannot take it under the self scheme. Actual user condition for advance authorization. Again, one clause has been added, and AEO having valid certificate has the option to produce self-declaration to this effect. So again, the fixation of norms at Delhi, which is a time-consuming process, is reduced in this particular case, and you can go for self-ratification for yourself. Of course, this would be subject to audit at a later date, but this is a activity of ease of doing business. And remember, this authorized economic operator is a status granted on behalf of World Customs Organization, but granted by national customs, and therefore it is advisable for every exporter that he must obtain this status. That will give him some additional benefits in terms of operational issues, not only under the policy, but also under the Customs Act. Importability, exportability of items that are prohibited or restricted. Prohibited items are not allowed. Restricted items are allowed. That's the second point that we must remember. Third point, which is critically important, that is added here, that is state trading enterprises. State trading enterprises are those companies which are registered under Government of India scheme, and they have been authorized to carry out business only for a particular commodity. One example of this is State Trading Enterprise STC, State Trading Corporation. Second example is MMTC, Metals and Minerals Trading Corporation. Now, first point to understand why there was a specific requirement given to them. Because when you import metals or minerals, the requirement of handling is completely different. Why completely different? Because the volumes that are handled are so large. A common exporter may not have that kind of arrangement. It will add to his cost. It will create additional problems. And therefore, it was decided that he should go in for this particular aspect. And in this entire case, if you want to import a restricted item, it is subject to NOC. Restricted item, which is reserved for state trading enterprises, can be imported by you by obtaining an advance authorization, And for getting the advance authorization, you require a no objection certificate from the specific state trading enterprise, say ASTC or MMTC. And it is also said that they can do this by charging a reasonable fee subject to a maximum of rupees 5,000 per applicant. So this is one additional window that is open, that state trading corporation should give you the no objection certificate for importing, and based on no objection certificate for importing, government will grant you advance authorization, so you need not pay, though the item is routed through them. So that is the practical advantage of this. Domestic sourcing of inputs. There was a problem when you want to source the material from SEZ units. What was the problem? All the SEZ units are not necessarily covered under EDI system. System has not been developed. So in such cases, till the system is created, they have created a separate provision that is called certificate of supply. So against certificate of supply, you would be able to procure material from special economic zones. You should be advance authorization holder. Utilizing this document, you will be able to source the goods without payment of duty. Some handbook provisions. Validity period of import and export obligation. Now, validity period of import and export obligation will be mentioned on advance authorization itself. Earlier, this was done separately in a sheet. Now it will be incorporated in the license, so it will reduce the paperwork. For advance authorizations not covered under para 439B, only one revalidation of 12 months from expiry date shall be allowed. No further revalidation would be allowed for such authorization. So these were specific items for which two applications were required to be made. First for 6 months, another for 6 months, and some particular items it was only 6 months. Now this is converted into 12 months. No two applications, only one application. No more two-time applications. This is ease of doing business. It will also reduce the transaction cost of the exporter. Regularization of bona fide default. Applicable interest payment online through IceGate payment gateway. So this is something that was done. For regularization, pay amount equivalent to 10% of CIF value of unutilized imported material. So the cost of payment is sufficiently increased from 3% to 10%. This is for those items which are subjected to restrictions otherwise. And this is one provision that is created. That has to be, if you are falling under this particular category, then only you will have to pay this money. In chapter 5, common utility services, government has created towns of excellence. They have added a few more towns in the clusters. And in clusters, if you want to create some common utility services, then such capital goods can be imported under this particular scheme, Town of Excellence or PM Mitra. You will have to refer to those. If you are a common service provider, utility services you are providing, telecommunication or transportation, electricity, water, gas, etc., etc. These specific services which are of infrastructural nature shall not be considered for benefit of CSP. Other than that, if you are providing services, then only this can be utilized. So this is, you must carefully remember that these services which are primarily of basic infrastructure nature will not be covered under common utility services. Export obligation. Following conditions will apply. Export under advance authorization, DFIA, duty drawback. They have added these two new schemes, ROS, CTL and RODTP scheme. You can claim benefit of this. Export made from DTA units shall be counted for calculation and or fulfillment of AEO and export of AEO and or AEO. So annual export has to be, this can be taken into account. Exports made from DTA unit. In other words, exports made from EOU unit, if it is part of your company, cannot be taken into account for the purpose of specific export obligation. So that has to be kept in mind. Only one benefit can be claimed. There were three different benefits. 5.04D, indigenous sourcing with 25% less CO. You have obtained a license for import of a machinery. Instead of importing, you are procuring it from a local manufacturer. Your export obligation will be reduced by 25%. One benefit under para 5.04. Second benefit under para 5.09, early fulfillment of EO. If you complete 75% or more exports in 3 years or less than 3 years, then your export obligation is reduced to 75%. 10. If you are exporting green technology products, your EOU is reduced. And under 5.11, EOU is reduced for northeastern region, Jammu and Kashmir and Ladakh. So in 4 different places, reduction of export obligation by 25% is permitted. What is government saying? That suppose you are a unit in Jammu and Kashmir, and you have also completed 75% exports in less than 3 years. You cannot claim both. You can claim any one. So you should not say, reduce my EO 25% because I am in Jammu and Kashmir, and reduce another 25% because I have completed exports within 3 years, 75%. So, nutshell, any one scheme you can take. You cannot take benefit of 5.04, 09, 10, and 11 simultaneously. Any one benefit you choose, you can take that. There was a case that unit goes into bankruptcy. Some unit has taken EPCG authorization without completion of export obligation. It becomes insolvent. Now there are cases where these insolvent units or the units which have become bankrupt are taken over. These sick units have been taken over by another company, and then another company is prepared to accept the export obligation. That was the old story related to sick unit. Now, because of the changes in the legal terminology, the revised version is like this. A company holding EPCG authorization, having been admitted under the provisions of Insolvency and Bankruptcy Code 2016 for commencement of insolvency proceedings, and in respect of whom the resolution plan has been approved under Section 31 of IBC 2016, may be permitted to relieve concessions and waivers. So waivers are possible, extension of time is possible, everything is possible in this case if such revival plan is already approved by these particular companies, this particular authority, and based on what is the plan approved by them. So it's a specific case. If some unit has become sick or you are trying to take over a sick unit and you want some concession in terms of export obligation, at that time, you should look at these particular aspects. 5.12, exemption from maintenance of average export obligation. In case of export of goods relating to the following, you need not maintain the average export obligation. Otherwise, the condition is that last 3 years, whatever is your average, you must mention, you must complete and then complete the obligation. But if you are an exporter of handicraft, handlooms, industries under Khadi and village, agriculture, aquaculture, fisheries, pisciculture, animal husbandry, dairy, floriculture, poultry, horticulture, viticulture, semiculture, carpets, coir, and jute. If your finished product is from these industries, then you need not complete, you need not maintain the average export obligation. That is a relaxation mainly for small units. And these particular units, if you look at the conditions, these are always providing more employment, smaller units, and therefore this has been specifically considered. Amnesty scheme is introduced. But please remember, though amnesty scheme is introduced for fulfillment of export obligation, where the export obligation is pending, this may not be useful so much for advance authorization, because this scheme is applicable for those authorizations which are issued up to 31st March 2015. Normal obligation period for an authorization is 24 months. Even if you take extension as per the old policy, 30 months, you think of this, if you add 30 months to the license issued in 2015, it is 2016, 2017, half of 2018. We are already in the year 2023. So the scheme may be useful for only EPCG authorization, not so much for advance authorization. And few pending cases which have not yet been sorted out may be closed due to this. So if you are having the case which is issued where the authorization is issued prior to 2015, then only you should look at it. Otherwise, this doesn't help you for current authorizations. Kindly note. Extension of export obligation period. Earlier, the fees were 5% and 10%. Now the fee is reduced to 2%. So benefit is given. Composition fee need to be paid on proportionate duty saved amount. So again, there is relaxation. This is primarily given because of the pandemic, 2 years, 1920, 2021, were bad years for exports. The world is going through the pandemic of COVID, and that is why what has been given. Regularization of bona fide default and exit from EPCG scheme will be in proportion to shortfall. Earlier, it was full payment of custom duties. Further, in case of local source capital goods under EPCG, for duty payable will be notional custom duties. Even if you have saved only GST portion on it, but you will have to pay back as if you have enjoyed the benefit of full customs duty. That is what that comes into picture. Export-oriented units. Unit will not be required to furnish bank guarantee. This is covered in para 6.11. Subject to two conditions. It is achieved necessary certification as an authorized economic operator. So it's AEO status holder. It has not been issued a show cause notice or a confirmed demand during preceding 3 years. And therefore, if you can comply with these two conditions, you will not be required to give any bank guarantee. There are no other changes in EOU scheme except for this. Chapter 7 is deemed exports. Now, what is deemed exports? Deemed exports is primarily a case of import substitution. What is import substitution? The item I am importing, instead I am procuring that item locally. Understand this carefully. I am an exporter of silk shirts. I have taken advance authorization for import of silk fabric. I am likely to import silk fabric from China. Instead, I decide to procure silk fabric from a unit in Bangalore. In this particular case, I am paying the local person in Indian rupees, not in foreign exchange. So as a country, I'm saving foreign exchange on one hand. Instead of importing, I'm procuring it locally. So it's import substitution. It generates employment for the local person. Now, why it is specifically covered as deemed exports? It is because the person in Bangalore manufacturing silk fabric imports silk yarn. And when he imports silk yarn, he pays duty. So his product is costlier. So government says, you supply me fabric, you import yarn, convert that into fabric, supply it to me. But in order to help you supply me fabric at the international price, I will give you exemption from payment of duty under advance authorization scheme, or if you have already paid duty on yarn, I will give you duty drawback by way of brand rate. Since the fabric supplied to me, I am an exporter of shirt, is not exported as it is. Fabric is getting converted into India, converted into a shirt. Shirt is being exported. That is why the term deemed export. I am supplying the goods within India. They will be converted into final product and exported out of India. But since they are supplied at international price, they are also supplied with the benefit of duty exemption. It is treated as deemed exports. So this is primarily a concept of import substitution. What are the categories of supplies? There are two categories. Supply by manufacturer. You are supplying goods to advance authorization holder, to annual advance authorization holder, or you are supplying goods to duty-free import authorization, or you are supplying goods to EOUs, or you are supplying goods to EPCG authorization holder. In such cases, supply has to be by manufacturer. There is another category of deemed exporter. Understand this. This is also very critical understanding. Supply of goods to projects financed by multilateral or bilateral agency. We'll take 1-2 examples, you'll understand. Here, the supply is not necessarily by the manufacturer. It is supply within India by main or subcontractor. What is happening in this particular case? Think of a project. Mumbai-Delhi freight corridor. For Mumbai-Delhi freight corridor, let's say Japan supplies money. You create the corridor in India, I will give you money. This money will be given to you maybe as a loan, which you will repay in foreign exchange at a lower rate of interest. Or bullet train project. Money will be given by Japan in foreign exchange at a low rate of interest. But the product created out of this is utilized for projects in India. It is not exported out of India. Now think of, for freight corridor, what will happen? Cement is required, steel is required. That all is supplied, either imported or supplied by a local company like Larsen and Toubro or Ultratech Cement. The condition of such supply is that since money is coming from abroad, the condition of this kind of project is the project authority must float a global tender. If cement is supplied from Korea to India, duty will not be charged. So government says, if duty is not charged from Korea to India, duty should not be charged on Ultratech or Larsen and Toubro, though goods are supplied in India. Within India, they should be treated as deemed exports. This is again at par with international transactions. So one transaction is this. Second transaction, supply of goods required for setting up any mega power project. Critically important. Because mega power projects are normally funded by international agencies. They are huge infrastructures. The limitation for this is 1000 megawatt. So if you are putting up a plant for 1000 megawatt and you are getting money from abroad for helping you with this, and the condition of the contract is that whatever imports coming from abroad is duty free, then the local supply for such project should also be treated as duty free. Third category, supply of goods to United Nations or international organizations, because those organizations get funding from abroad. And fourth category is supply of goods to nuclear power projects. Again, nuclear power project, mega power projects are critically important for power generation. All of us know what is the importance of power. I can talk to you on this project because of electricity. If there is no electricity, if I cannot work like this, I will not be able to reach you. So for all our activities, power projects have become critically important. Government has decided to give them this particular benefit of deemed exports. In this particular case, there are two categories: supply by main contractor or supply by subcontractor. Suppose bullet train, money is coming from Japan, the contract is given to Japan, but Japan appoints Tata Steel as their subcontractor. Then goods supplied by Tata Steel to bullet train project will be treated as deemed export. This is how the scheme operates. To qualify for deemed export benefits, your product supply must be covered under para 7.0. Only the products which are covered under 7.02 specified ones can be taken as deemed exports. Other normal supplies will not be covered under this. And in deemed exports category, there are two benefits available to you. You can claim advance authorization for your input of raw materials. Alternatively, you can claim deemed export drawback. And the project authority or the ultimate receiver can claim input tax credit on GST. If he is prepared to give you NOC, if he is not taking the credit, then you are able to claim refund of GST. So again, deemed export category, this chapter relates to what we call as indirect tax exemptions by way of advance authorization for deemed exports, or duty drawback by way of deemed exports drawback, and refund of GST or input tax credit. So it neutralizes the treatment of indirect taxation. That is the point we must carefully remember. So if we cover all these schemes and we start looking what are the benefits that are granted. Under chapter 4, the impact is reduces cash outflow. You need not pay duty. You have no interest cost. In chapter 5, reduces cash outflow. You don't need to pay duty. No interest cost. In chapter 6, reduces cash outflow. Good scheme for joint ventures. Not subjected to licensing. Saves custom schemes of the FTP are primarily for the purpose of indirect tax management. These are all tools of indirect tax management that we must remember carefully well. As I told you, every scheme is governed by exemption notification. Unless until custom issues a notification, you cannot get the benefit of exemption from payment of duty. And while doing so, very recently, Customs has issued notifications. I have made a list of it. For advance authorization, notification number 21, 1/4/2023. Advance authorization for deemed exports, notification 22. The right column gives you from which duties you are getting exemption. 23, advance authorization for annual requirement. 24, advance authorization scheme for export of prohibited goods. What are they exempted from, etc., etc. Notification 24, duty-free import authorization, DFIA scheme. Notification 26, export promotion capital goods scheme. And notification 27, special advance authorization under schemes under para 4.04a. The right side gives you the list of what is exempted, which duties are exempted, etc., etc. So you can refer these notifications and correct it. Then take advantage of it. Then comes the next chapter of the policy, chapter 8, quality complaints and trade disputes. What is this chapter? The complete procedure for quality complaints or trade disputes relating to international trade is now online. Understand this. There are two kinds of complaints. One, the claim filed by the importer against Indian exporter. He has supplied unfair quality. He has supplied goods, unethical practices. Anything of this sort. and because of which some sort of trade dispute is arising. The buyer is refusing to pay money to the exporter. He wants to claim he has paid money, he wants to claim back his money. So complaints registered against Indian exporters, which are normally registered with the Indian embassy in that particular country. Second, Indian importer filing a complaint. I have imported some material from China. I am a small scale guy. He has not supplied me material of good quality. He promised something else. He supplied something else. I want to file a claim against him. Can DGFT support me? Now, is it a final solution? Answer is no. This is a solution which can be taken up at political level, which can be taken up with Embassy of India, and to some extent, some dispute can be sorted out. Some quality complaints can be sorted out. Let me give you an example. Suppose I am an importer, a small scale importer. I imported goods worth $5,000 from China. Quality is found bad. I make a complaint. Complaint is registered with DGFT. DGFT sends some letter somewhere. And as a result of this, nothing is happening. The problem is I'm too small a person. My amount involved is also so small that I cannot take up this issue legally. But then DGFT finds that same item is exported to 10 different companies by the same Chinese company. And we find that total import is coming to $2 million. Now, this is a completely different case. So, DGFT office through this mechanism goes to Chinese embassy, say this exporter, I have received complaint against this. And if the complaint is not sorted out, I will put his name under blacklisting. What is the difference between the two? Is it a legal solution? It's not a 100% solution, but it is exercising some pressure on the exporter from that country, that if you are thinking that, okay, you lose a buyer worth $5,000, you don't care. But if you lose the market size of $2 million, you will definitely care. So that helps raising the issues, sorting out the disputes, and it also helps creating an atmosphere where there is possibility of dispute resolutions. How and what provisions are made? The committee situated at regional office level can authorize the export promotion agency or any technical authority to access whether there has been any technical failure of not meeting the standards, manufacturing design defects for which complaints have been received. Initially, efforts will be made to settle the complaint or a dispute amicably, discussing with each other. In case the matter is not settled amicably, action may be taken against the erring Indian entity in terms of Foreign Trade Development and Regulation Act 1992 as amended. So this is a case where complaint is registered against defective quality, defective designs, or technical failure registered against an Indian exporter filed with Indian Embassy abroad. This is the remedial solution for that. Complaint against foreign entities that we are complaining as importers will be taken up for settlement by the respective foreign trade division in the Department of Commerce through Indian missions abroad. Indian missions abroad will take up the complaints against the foreign entities with authorities concerned. So they will write. In case the Indian missions abroad are satisfied about the malafide of any foreign entity, they shall send such information to DGFT for circulation amongst the EPCs, commodity boards, ECGC, and other regulatory authorities. So if it is found that certain person has malified intentions, then this is what I am saying. The blacklisting will take place. That will be communicated to all export promotion councils, and they will put it on the website also. So you will be able to know that this person's credentials are not good. I should not import from him. This is what it summarizes. A new para has been added. A case officer will be assigned for monitoring purposes in the designated regional authorities or resolving complaints and trade disputes in a time-bound manner. Then we come to promoting cross-border trade in digital economy. Objective. This is a new chapter. Objective of the chapter is to provide a framework for cross-border trade of goods and services from India in the digital economy and the promotion of e-commerce, other emerging channels of exports from India. So not only e-commerce, mobile commerce, anything else that is coming up, that will also be looked into. E-commerce export of goods, selling through the internet or an e-commerce platform, payment for which shall be done through international credit or debit cards or other authorized electronic payment channels, and as specified by the RBI from time to time. So any revision that is required in RBI laws and rules, that will be carried out. Para 9.02E, commerce export of services. Again, service payment can also be done through international credit or debit cards. And this could be a very wide-ranging activity. For example, somebody from abroad wants to know about export-import policy of India, and he sets up a meeting with me. And he asks me, what are your charges? And I tell him, these are my X charges per hour. And he says, okay, we'll set up this meeting and I'll pay you money using the credit card or any other authorized electronic payment channel. So we'll fix up this meeting for tomorrow. And then I say, okay, you send me so much money. So he sent me X amount of money that is credited into my account. And then I give him services through electronic means. On internet, we are talking. Am I sending any goods? Answer is no. Am I rendering services? Yes. Am I discussing issues? Is it a personal service? Yes. Who is the beneficiary of these services? The party abroad. Is he prepared to pay me money in foreign exchange? Yes. This will help development of services from India. There are a number of people trying for this. Now, which are the services which can be of great value in this particular aspect? Medicinal advice, then lawyers, chartered accountants, classification issues, any dispute resolution, anything of this sort can be covered under e-commerce. So this is one new area that is emerging, and everybody should take advantage of this particular aspect and think of developing this, what best we can do in this particular case. Para 9.03 e-commerce platform. So creating the web portal, enabling the commercial process of buying and selling through this internet medium, that will also get covered under this. So idea of the government is to make sure that we should promote export of goods, we should promote export of services using digital methodology. And that is why this chapter has been created specifically. Then we come to a chapter 10, SCOMET. Please understand the meaning. This is short form of special chemicals organisms, materials, equipment, and technologies. These are specialty products which has dual use. One use, weaponry, atomic, another use, industrial. Take a simple example. There is a desalination plant. So desalination plant converting water, seawater into heavy water into light water or drinkable water, treating them. This is industrial use. Some machineries required for this plant can be used for enrichment of uranium. That can be a nuclear use. If the machines, the chemicals, the materials are of dual use, then they get covered under SCOMET. And there is a lot of clarity that is provided in this. So let's understand. The general provisions governing the export of dual use items, munitions and nuclear related items, including software and technology, are dealt with in this chapter. Let me give you 2-3 new examples of this so you'll understand. In Russia-Ukraine war, a drone is used for the purpose of delivering some material which can cause a serious damage. So it's a missile, but utilized using the drone technology. Drone can also be utilized for delivering certain material to certain designated place, which can be for healthcare, which can be for critical industrial use, or which can be for nuclear related items or military related uses. So this is the item of dual use. Technology is so advanced today that you can do number of things, and the technology can be used for good purpose, technology can be used for bad purpose. This is true for every single technology that you put in place. The electricity that gives you power, electricity that gives you steam, electricity that gives you something, same electricity because of a short circuit can create a havoc. So monitoring of these plays an important role. Any technology does not have good or bad in itself. It is dependent on its use. So the destructive use needs to be controlled. They should not be utilized for destructive purposes, and therefore controls are exercised. Para 10.2, export of dual use items, including software and technologies, having potential civilian industrial applications, as well as use in weapons of mass destruction is regulated. Please understand, the same technology can be used for civilian use, for industrial application, or for the purpose of weapons. And weapons of what? Weapons of mass destruction. It is either prohibited or is permitted under an authorization unless specifically exempted. So it will be controlled. Where do you find this format list in the first place? You will find it in Schedule 2. Schedule 2 of ITCHS book. Schedule 1 relates to imports. Schedule 2 relates to export. This is export subject to conditioning, and therefore you should see it in Schedule 2. Third, classification of SCOMET categories and licensing jurisdiction. First, these items have to be divided into proper categories because it's a long list. Then we must also decide who will grant the permission to operate on this, who should be the authority to allow, because this is not something which can be commonly utilized. Let's understand this. If you have a small child in house, certain products you keep away from him. You take care of that. You don't leave knife anywhere. Anything critical chemical, you don't leave unattended. Why do you do this? because it can create damage to the child. Same thing. If anything is creating damage, then it needs to be controlled. And who need to control that we must specifically work out. If we don't do that, it would be difficult for us to understand why we should. So a proper mechanism has been created for this purpose. The products are divided into 9 categories. Category 0 to category 8, total 9 numbers. Category 7 is presently reserved, has not been populated. That means no allocation has been made. And broad classification is given. It is tabulated along with their jurisdictional licensing authorities. That means who should allow you to export these goods? If the goods are subjected to restrictions because of dual use, which is the authority to whom you should go for obtaining licenses, obtaining permission, obtaining NOC, whatever is prescribed. That is covered under this particular table. We'll go through the table also. 0, nuclear materials, nuclear related other materials, equipment and technology. Anything and everything is covered under Department of Atomic Energy. That is the authority permitting you to do this, including items mentioned in Note 2 of SCOMET list. This is available in Schedule 2 of ITC-HS book. Please look into this. Toxic chemical agents and other chemicals covered under DGFT. Microorganisms or toxins are covered under DGFT. DGFT will grant you the license. Materials processing equipment and related technologies, DGFT. Nuclear related other equipment and technology not controlled under category 0, DGFT. Aerospace system equipment including production and test equipment, related technology, specially designed components and accessories, DGFT. Munitions list, Department of Defense Production, Ministry of Defense. Category 7 reserved. And then special materials and related equipments, material processing, electronic computers, etc., etc. Connected to defense, and we need to protect the country. Depending on all this, you have a clear idea where one should go and obtain a SCOMET license. Please remember, SCOMET item 99% is exported only against a license. Unless until license is granted, you cannot export that product. If the product is of dual use and well defined, then in that case, it may be subjected to NOC from these departments. So that has to be looked into very, very carefully under this particular situation. Having understood the policy, the coverage of policy, the critical amendments of the policy, now we have to look at what is the way forward. What we are practically looking, why the policy has been created. Policy has been created primarily for the purpose of extending our global footprint. So first step, foreign trade policy to be dynamic and responsive to the emerging trade scenario. These two words are important. Dynamic, it should cover many more areas, and responsive. Responsive is critically important. The government machinery should respond to your queries and should sort out the problems, because we would like to increase our global footprint. First part. Consultative mechanism to resolve issues of trade and industry, whether it is under Chapter 8 or under ODOP scheme. We have to monitor this carefully well. working towards making the Indian rupee a global currency and allowing international trade settlement in INR. This would be possible in times to come. RBI has already issued instructions for this in July 2022. Depending on the countries and our trade relationship with them, can we shift focus from dollar to rupee currency? And can rupee currency be accepted by the buyers? Are they prepared to keep their money converted through a special escrow account, deposit in India, and pay from that particular amount, credit amount, for purpose of their import requirements? If all this works smoothly, then this will help this particular cause. Wider engagement with states and district. This is what is aimed at district hubs, district export hub scheme, and 122 districts have already been identified. Products have been identified. Postal encouragement has taken place. So this all can go under this. It envisages participation from district level, from experts, from state level, from central level, working out programs, outreach programs, skilling, everything is going under this particular category. Focus on e-commerce exports. As I told you, the estimated e-commerce exports by 2030 are likely to be $8,000 billion. Very huge amount. The potential envisaged by this policy is $200 to $300 billion, which does not really include services. It is only of goods. So it's a good move to go towards, and we must expand, enter into new spaces, new export areas. We must look how can we grow in e-commerce space. That is critically important for us. And apart from this, sector specific targets. So procedural issues need to be sorted out, streamlining processes, and then sector specific targets. If we really want to achieve $1 trillion merchandise exports and $1 trillion services export by 2030, then we got to be looking into sector specific targets. So deeper study based on the HS code, based on the potential of other countries, the changing environment, sustainability, climate changes, n number of things have to be considered in this. And please remember, even if it is a manual mistake or negligence, can cause trade damage to a great extent. Yesterday, there was a fire in Dhaka in Bangladesh, and 4,000 units were gutted under the fire, all clothing market. The loss is estimated to be more than $200 million. Why this has happened? Three things. Must have been short circuit somewhere that will come out of investigation. Too many people concentrated in a smaller place. And third, very critical aspect, maybe half of the shops did not have any fire extinguishers. There is no pipeline. There is no water available. Nobody bothered to maintain fire extinguishers in that particular place. So any negligence of this sort can be very, very disturbing in long term. That has to be kept in mind all the time. If we have to achieve a bigger target, we must actually look at how one should go about it. It's critically important. And finally, restructuring of Department of Commerce. This process is going on to make it future ready. How the department should move away from licensing and contribute to growth of exports. That is something one has to look at very, very seriously, and one should look at, because that's the way we will have to understand and make sure that we move towards this target. We'll have to think of this sooner or later, because if every single country is interested in exporting to India, we must also have a very strong desire to export to many other countries. And if we can do that successfully, we would be able to achieve this target of $2 trillion by 2030. I have a thought for you towards the end, then we'll go for question and answer. And this is a very interesting thought. Again, it comes from Buddhism. Anything which is troubling you and anything which is irritating you, that is your teacher. You know, because what troubles, you try to find out a solution. What irritates, you try to find out a solution. What troubles me? I need ease of doing business. What irritates me? My global footprint is very, very small. If I clearly look at what is happening on these aspects, I will automatically understand what I need to do. And then the trouble or irritation itself becomes my teacher. And that is very interesting thought process. So that is how I would like to conclude. Thank you so much. Thank you, Sushma, for this opportunity. I could talk to all of you. And now, last 10 minutes, as usual, we will go for question answers. So I will stop sharing and then we'll look out for question answers. Please feel free.
Hello. Yes, sir. So
Yeah.
hi, dear. Session is completed and I hope it is very good and knowledgeable. You got a lot of insights. So if any questions, you can comment in the comment box. Okay, Avinash is asking, as you said yesterday, there are only 6 lakh exporters. Is it due to monopoly or what is the reason?
No. See, most of us still do not feel export is a reality. Export is something we should pursue. A little awareness. It's a question of awareness, more of awareness.
Right. That is true actually.
Yeah. And an inherent fear that I will not be able to do it. Why should I do it? There may be risk into. These are the questions.
That's true. Okay, Hiteji is asking how to quote the right price.
To understand the right pricing, you must study the Incoterms. If you study the Incoterms, it will tell you what services have to be included into the cost that you are quoting. As long as you can scientifically do your work, you will be able to quote the right price.
Okay. The second is how to know what price is offered by our competition countries.
You will have to study the international statistics. You can do that. You can go to the country's website, check. You can write to Indian Embassy abroad, get an average price for that particular product.
Okay.
Depending on your relationship, you can definitely find out these kind of things.
Okay. The third is what is deemed exports?
Deemed export is import substitution primarily. Goods supplied within India, which can be utilized for further export production.
Okay. The fourth is where can I find circular related to merchant trade? Example, buying for America, selling to UK on RBI website.
You look at the master direction for import of goods and services. There is a separate para which says merchanting trade. You will get the details there.
Okay, that's great. Next is there any trade agreement between India and Thailand?
India?
And Thailand?
Yes. India, Thailand, there is a trade agreement, and also Thailand is a member of India ASEAN. The best option for your product, if you want to check, go to Indian Trade Portal, check online. You will get the, if you know your HS code correctly, you will also get whether you are getting any duty benefit in Thailand.
Okay. Alok is asking, sir, how is road tape and ROCSTL different? Can a garment exporter take refund of both or only
No, only one. Only one. ROSCTL is for textile sector.
Okay. Please clarify if we get payment in Indian rupees in export from India, still we get incentives.
Yes, as long as the payment in Indian rupees is coming from special Vostro account. This is critically important that buyer and his bank must open a special Vostro account in India deposit money in that account, and if you are paid from that, you are entitled to claim all benefits.
Okay. Without going to the Indian embassy, how can we find the buyer from online?
That is a little difficult. You can you can create a website. If you are famous enough, people will try to reach out to you. If not, you put yourself on some platform.
Yes.
And you can get coverage from there. And subsequently, once you develop that, then you can have your own.
Yeah, sure.
Or you come out with, I will tell you one thing more. You come out with a product which is so attractive, everybody should be interested in that. Then also people will try to reach you.
Yes. Okay. The next is, sir, how can I make brand in international market? Please suggest.
Brand in international market depends on three things: extremely good quality of product, extremely good quality of services, and key word I will say is zero defect product. If you can guarantee zero defect, people will be interested in you. Then create a nice website which should talk about it, reach it to the people. It will automatically receive.
Okay. How does beginner compete with star exporters?
There is no need of competing with anyone. You become a star exporter yourself by increasing your volumes.
Yes.
See, higher the volume, I'll give you a very interesting example. You'll laugh if I tell you. If you are exporting 30 containers a month, a shipping company will appoint a representative only for you. He'll come and sit in your office, check, sir, what is happening today? When are you giving? If you are exporting goods half a container, nobody will bother about you. You will go to someone else and check if bhaiya kuch ho sakta hai.
Yeah, right.
30 container will enjoy a better freight rate compared to a person who is exporting less than half a container. So it always goes with volumes.
Yeah, right. That's good. Next is like, how do we find the trends in a particular country? What is popular products so that I can customize my product to suit the country needs?
A lot of things can be seen. You have to study the culture of the country, the source. I have said this in yesterday's session. You should do pestle analysis. You should understand the trends of the people. Let me ask you, this person who is asking this is from which place in India?
Arup Sinha, can you tell us?
He's from Bangalore. Okay. So let me ask you a question. How will you sell a product in Himachal Pradesh? What will a person from Himachal Pradesh will like? Will it be more South Indian or will it be more North Indian? What he would love? So ultimately, how will you find out? You will find out through geographical means. You will find out through cultural information. What are the trends in that particular place? Same thing applies. Internationally also, you check what people like.
Yes. Abhishek is asking, EvoU is best option for ethanol industry and electronic vehicle too.
Yes.
Okay.
It's a base scheme for joint ventures. If you trust each other, you can get very good advantage of this scheme.
Okay. Rahul is asking how we can promote our product.
Promotion, there are n number of ways. You can have a special appointment with him and discuss how to promote the products. Using website, e-marketplaces, moving into creating a small, first create a small group of people who are interested in your products. And that could be the first step, then it moves.
Okay. Okay, any question? What is the effective ways to converting buyers?
Buyer, see, is a very good saying. I should tell you that. It's a person who received a gold medal for selling highest number of insurance policies. And somebody asked him, how did you sell this policy? He said, I haven't sold a single one. I was always careful of selecting that person who wants to buy.
Yes.
So as long as there is a person who wants to buy from you, you reach out to him, it will grow. Shouldn't be a problem.
Yes, that's true. Yes, any last questions? So मुझे एक क्वेश्चन पूछना था एक्चुअली इन द एफटीपी highlights actually I have read fruits and vegetable exporters are being included for double weightage for counting export performance
Yeah,
under eligibility criteria for status
yeah,
of certification.
yeah.
So उसका
So
थोड़ा मीनिंग क्या था?
उसका मीनिंग ये है कि स्टेटस certificate 1 star is given to you when you achieve a target of $3 million.
Right.
If you are exporter of agricultural products, then if you achieve the target of 1.5 million, you will be considered as if you have done 3 million export.
Okay, okay. So that is a double weightage.
Yeah.
Okay, that's good then.
Yeah.
Yes, yes, yes. Okay. So any other question? I hope you all enjoy the session and a lot of insights about the export policies and many things actually. Incentives ho ya baki sari bahut sari cheezein hai. Okay, Sheikh is asking how to open OSTO account.
OSTO account, you check with AS Bank. AS Bank has some proposition and they have got approval from RBI. So the bank in the overseas country has to open a special OSTO account in India, deposit money that will be utilized as rupee payment, and you will get payment from that particular account.
Yes. Okay, any last 2 questions we will take now? Any questions you have? Meaning of sourcing agent.
Minimum?
Sourcing agent. Meaning of sourcing agent. How it works.
Sourcing agent is somebody who is appointing you from abroad as his representative to buy goods within India. Like you appoint an agent abroad for selling your goods, somebody from abroad appoints you as sourcing agent. It's a good initiative to expand because your local circle you know well, and you would be able to promote the right kind of products.
Yes, yes.
And you will get paid from the fellow abroad.
Yeah. And the last question from Dikujal, how can we break monopoly as a fresher exporter?
No, it's not a question of monopoly per se, because breaking monopoly, you forget. For the time being, you just concentrate on one thing. How can you create competitive quality products? Because at the end of the day, any buyer in the world would like to buy a competitive product as long as quality is not compromised.
Yes.
So good quality product, reaching out to people. Once you start, business will grow.
Yeah.
So let me ask him a question on my behalf. Would he like to listen to me once again? Yes or no?
Yes.
Why? Why would you like to be listened to once again? Reason is very simple. What I have spoken, you must have liked it. So instead of bothering about, what is monopoly, etc., try to create your value, increase your value all the time. If you do that, people will demand for you. It's not a big problem.
That's true. So I hope you all enjoy. Yes, your feedbacks are also getting like, yes, there's in simple words, sir has explained a lot of things actually. And yeah, many more things actually we have planned further also. So thank you so much to Kasturi sir. Actually, they have given their precious and valuable time to us, because sir ka time milna itself is a big thing actually. But yes, we have made that efforts and it is succeeded. So whoever joined this program, I am so much thankful to all of you. And Global Fortune has got this opportunity to connect with Sudhakar sir, and we organized this session. So Global Fortune and team ka bhi matlab, thank you. They have taken these efforts and they have reached to you. And lot many sessions actually together we are conducting in the future also. So stay connected with us for that further sessions. And I hope like कि आपको और भी सुनना बहुत अच्छा लगेगा सर से. तो बहुत सारे सेशन है. हम आपको एक गूगल फॉर्म भी भेजने वाले हैं फॉर द फीडबैक एंड फॉर यूर सजेशंस कि आपको कौन से और सेशंस चाहिए, तो उसमें भी मतलब आप हेल्प करना कि आपको और क्या सुनना है और मार्केट से आपको क्या चाहिए. So that also will be cater and Global Fortune will organize that all the things. So once again, thank you so much. Yes, Kasture sir, thank you so much to all the audience and thank you so much who has organized all the things actually.
Thank you.
My team especially, they have taken all the efforts.
Thank you.
Yes, thank you so much to all of you. And for any need, you can always connect to the Global Fortune. You can follow us on social media. KDSushma is on the social media. So YouTube, like Facebook, LinkedIn, Twitter, and you can follow us there. So yes, and on a mission to create 10,000 plus exporters, and that will not completed without Kasture sir also and without you all. So together we can achieve many more things and definitely look forward to listen more and more and to join together. So once again, thank you so much for all the things, PPT and recordings. You can connect to the team and they will share you that all the things with you. So thank you so much once again. Take care and
Thank
take
you.
action.
Thank you.
Okay, bye.